Is there anything more terrifying than the thought of being forced out of the home you spent a lifetime paying off, not because you couldn't manage the mortgage, but because you can't afford the property taxes? Listen to me. Property taxes are a silent, creeping retirement killer. You do the right thing your whole life. You save, you sacrifice, you pay off that 30-year mortgage, and you think, finally, I am safe. I own my home free and clear. But then reality hits you right in the face. You don't own that home free and clear. Because if you stop paying your property taxes, the county will step right in and take your home away from you. It is a harsh, brutal truth, and it is driving millions of seniors into a state of panic. They are trapped on fixed incomes, while their property values skyrocket, and along with those values, their property tax bills are exploding. It is a massive problem, it is creating overwhelming fear, and the number one question I get from people just like you is, Susie, how do I stop the bleeding? How do I reduce my property taxes so I can actually afford to grow old in my own home? Today, we are going to fix this. We are going to strip away the confusion and give you the exact, actionable steps you need to take right now to protect your sanctuary. First, you must understand the core of the problem. When you are working, a 5% or 10% increase in property taxes is annoying, but you manage. You adjust your budget. But when you retire, your income locks into place. Maybe it's Social Security, a modest pension, or systematic withdrawals from your 401k or IRA. Your income stays flat, but your expenses do not. And unlike your grocery bill or your utility bill, where you can choose to cut back, buy cheaper brands, or turn down the thermostat, you cannot choose to pay less property tax on your own. If the assessor says you owe $8,000 this year instead of $6,000, you have to pay it. This is creating a crisis of cash flow. I see so many beautiful, proud pre-retirees and retirees who are completely house rich but cash poor. They are sitting on a home worth $600,000, but they are living on $2,000 a month, and a massive tax bill completely paralyzes them. They fear they will have to sell the home they love, leave their neighbors, and downsize when they absolutely do not want to. So, let's answer the ultimate question: how do property taxes actually work in retirement, and how do you reduce them? You need to understand that your property tax is calculated using two main levers, the assessed value of your home and the local tax rate. You cannot control the tax rate. That is set by your local government, your school districts, and your county. Here is your first massive actionable takeaway: you must look into your state's senior homestead exemption or senior tax credit immediately. Almost every single state offers some version of this, but it is a well-kept secret unless you go looking for it. For example, look at what states are doing right now. In places like Texas, they recently expanded the homestead exemption significantly, giving seniors a massive shield against high assessments. In New Jersey, they just rolled out the historic Stay NJ program alongside their senior freeze, which literally caps or slashes property taxes in half for eligible seniors to keep them from being forced out of the state. In Florida, if you qualify for the homestead exemption, you get the Save Our Homes cap, which prevents your assessed value from rising more than 3% a year, and if you are 65 or older with a limited income, many counties allow an additional $50,000 exemption. What does this mean for you? It means if your home is assessed at $300,000, a strong senior exemption might knock that taxable value down to $200,000 or even lower. You are still living in the exact same house, but you are suddenly paying taxes as if it were worth a fraction of the price. But you have to qualify, and you have to understand the criteria. These programs generally look at three things: your age, your residency, and sometimes your income. Some states open up relief at age 61 or 62, while many require you to be 65. Next, it must be your primary residence. You cannot claim these senior tax breaks on a vacation home or a rental property. It has to be your main sanctuary. And finally, some of the most powerful exemptions are tied to income limits. They will look at your modified adjusted gross income. This is why tax planning before you retire is so critical. If you pull a massive, lump sum distribution out of your traditional IRA to buy a car or pay off debt in one single year, you might accidentally spike your income, cross the threshold, and disqualify yourself from thousands of dollars in property tax relief the very next year. You must be smart about where you draw your retirement income from to keep your income optimized for these local tax breaks. If your primary goal is to maximize the inheritance you leave to your children, a tax deferral can significantly chip away at the equity they will receive. But if you are truly struggling, if you are choosing between buying your prescription medications, putting food on your table, or paying the county assessor, you must choose your own well-being first. Your children will understand. Your home equity is there to serve you and protect you in your final years. If a deferral program is the only way you can safely stay in your home without constant financial terror, you look into it and you use it. To wrap this up, your marching orders are clear. Do not sit back and let rising property taxes ruin your retirement peace of mind. This week, I want you to pick up the phone or go online to your local county tax assessor's office. Search for senior property tax exemptions in your specific county and state. Download the forms, check the deadlines, and verify the income and age limits. If your assessment just went up, look at the appeal deadline and check your property card for errors. Take control of your money, take control of your housing costs, and protect your hard-earned retirement. You can do this.